There's no getting around the fact that money's the most emotionally charged topic in our lives. There's lots and lots of data to support this, more so than politics or mortality or religion. You name it, money is the number one most emotionally charged topic that any of us deal with, tying a lot to that survive and thrive evolutionary dynamic.
In 1994, a young analyst joined one of the most secretive and well-respected hedge funds on Wall Street, Seth Klarman's Baupost Group. He was one of just 6 generalist portfolio managers. And Klarman taught him a single idea that shaped his career. Risk is a function of downside, not volatility. 20 years later, Andrew had a heretical realization. Most of what hedge funds were charging 2 and 24 were not achieving alpha. It was beta, exposures that you could replicate cheaply in an ETF with daily liquidity. So he built a firm to prove it. Today, Dynamic Beta Investments runs $2.2 billion and manages the largest managed futures ETF in the world. Andrew doesn't sell private real estate. He sells the discipline of asking what you're really paying for. Last episode, Phil Shankweiler made the case for institutional private markets. Today, we test it. When you pull back the wrapper on every allocation for alternatives in the modern portfolio, and what does that mean for asset classes that can't be genuinely replicated? I'm Samantha Paranello, and this is Wealth Unfiltered. Hi, Brian. Thank you so much for joining us. I'm excited to have you on the program.
Happy to be here.
Wonderful. Well, I want to get started. First of all, I think it would be great for our audience, for anyone who hasn't read your novel, or I should call it a book, really, or hasn't really heard about how your mindset works. I'd love for you to give a little bit of background on yourself and let us know about maybe some of like the major points that you can read about in your books, and then I will really dive into some of my questions.
Okay, no, it's great. Yeah, so I'm Brian Portnoy. I'm the founder and CEO of Shaping Wealth, and we're a learning and engagement and growth platform for the global advisory industry. So our clients are financial advisors all over the world. We have clients on 6 continents. I've yet to meet a financial advisor in Antarctica, but when I do, I'll have all 7 covered. Kind of a 25 plus year career in financial services, split between investment management and wealth management. So for the first 15 plus years of my career, picking investments, managing portfolios, and kind of had one major sort of brain flash quite some time ago, which was that investing is more of a psychology problem than a math problem. And as I kind of navigated markets and met investors and managed portfolios, that just became more and more true, which kind of led me to be fascinated by the field of behavioral finance, which is a fancy term for the psychology of money. And so last decade, I published 3 books in the field of applied behavioral finance. And the one that I'm best known for is called The Geometry of Wealth. And there I coined this term, funded contentment, the idea that true wealth is the ability to underwrite a meaningful life. And that's very different than being rich. And rich is the search for more, and that's not at all a bad thing, but it is different. So I kind of made this distinction between rich and wealthy, and the book took off, and ultimately I transformed the Geometry of Wealth book into a coaching and content platform called Shaping Wealth. And in some sense, we're a traditional learning and development platform where we've got courses and workshops and coaching sessions and content. And over the last year, not surprisingly, we've leaned very heavily into AI, and we can maybe talk about that. I think there's a lot of interesting innovations that we're driving in that space. So yeah, that's a relatively quick summary of a 25-year career.
So what made you shift from doing like advisory portfolio management into the behavioral part of finance? Was there like a moment that you really like realized that this was more of what you wanted to do?
Yeah. And it was really going back 2010, 2011, 2012 in that time frame. I had just been in the weeds on the manager selection front, in the fund of funds space, on the family office space, where it was pretty clear that to me that for the most part, for most people, investing is a solved problem, that there's actually very rarely a premium for complexity, that trying to make things complicated, which is what the investment industry tends to do, was for the benefit of the fund companies, not for the benefit of the investors, and that ultimately it was our emotions, our psychology, our decision-making acumen that was really driving great financial success. So that really was the point at which I pivoted into focusing more on the behavioral side of things. And it was a big pivot because I got away from portfolio management, got more into writing and educating, but then also coaching. And yes, worked with tens of thousands of end investors, but the emphasis of the work that I've done over quite some time now has been with financial advisors. So financial advisors are always looking for better ways to connect with their clients, to provide better service, and coaching that I do, that we do, it helps them better understand who they're working with, how to build better plans, better portfolios. And that to me has just been a more rewarding take for this stage of my career.
As you keep speaking to professionals, are you looking at this and you're seeing, I don't want to maybe say systemic, but are you seeing like an overarching like item that you're like, man, they're just really looking at this the wrong way or they're doing this the wrong way and you're helping them shift the way that they do things?
A little bit. I mean, I guess there's a sample bias in who our clients are and who we work with. I mean, it's not my job to convince somebody that they're doing something the wrong way, and our industry is just absolutely massive. So, to this day, here in, mid-2026, you've got financial life planners and financial life coaches who go deep into financial therapy and financial psychology and truly deeply understand their clients. And right down the street, you've got old school hard-nosed brokers who are kind of selling you some sort of security or investment product or something like that. And both are in business and both are doing well because there's a huge market out there with different customers and clients wanting different things. So I think where I'm at with my firm, with my career, with my network, it's that if you're here looking at this stage of the market, trying to add value by picking better stocks, by, building a portfolio that has a slightly better Sharpe ratio than the next guy, and then communicating that your value add to the market is being a better investor, I'm going to be a little bit skeptical. If your value proposition is, hey, I'm really going to listen to you, I'm going to understand where you're coming from, where you and your partner and your family, where you're coming from and what you want to do, and help you build and execute on a plan that really helps you lead a truly wealthy life to achieve that idea of funded contentment I mentioned earlier. I think the market is massive for that and it's wide open. And so the general shift from focusing on the portfolio to focusing on the plan, that's the big trend. That's where the big wealth platforms are or are going. And that's what I'm sort of associated with.
So I love that. And you mentioned your book, Geometry of Wealth. And what I read was that it's actually been translated into 15 languages. So like you were mentioning the how vastly well it's been, I think, received. Why do you think the term or the way that you talk about funded contentment has really resonated beyond the US?
Yeah, because humans are human everywhere. That there's 8 billion of us trying to figure this stuff out, Samantha, and everybody's a little bit lost and everybody's a little bit hopeful and everybody's a little bit scared. I think it's funny when we do work, we've done work for some very big private banks, like global private banks, where your typical client has a nine-figure net worth, and there's plenty of billionaires around. These firms will say to us, "Hey, if you're coaching and your seminars and your workshops, please take into account that our clients are really, really rich." I say respectfully, I don't care.
Right.
And there's really nothing about the human experience, and specifically the human experience of money, that sort of bends itself to the size of your balance sheet. That from an evolutionary psychology point of view, we're all wired the exact same way. And I just summarize it as saying survive and thrive. You, me, everybody we know, we're in a never ending cycle of survive and thrive. Every day we need to get up, keep ourselves safe, keep our families safe, keep our community safe, and you get through the day. And assuming you get through the day, then you can reach for more. And that's a really good thing. And whether you're in the US and just getting by versus a billionaire, whether you're here or in rural India or in Australia or name the place, human psychology, human neuroscience is what it is. And we're all aspiring for that sense of safety, that sense of contentment, that sense of connection with others. There's a bunch of things that truly make us human that transcend time and history and place. And so I think the reason that some of the stuff that I've written about has landed well all over the world is because I'm just speaking to the human condition generally with a little extra zhuzh on money and figuring out where money fits into the human experience. And the subtitle of the book, Geometry of Wealth, is How to Shape a Life of Money and Meaning, giving people a framework and a vocabulary and a perspective on how to think about money in the general quest for a meaningful life. That's something that all of us probably want to figure out a little bit.
I think you nailed it 100%. And so when you talk about the distinction between rich versus wealthy, and you're talking to a portfolio manager advisor, when they're sitting across from a client, what is maybe one way that they kind of approach that conversation with their client?
So let's unpack the distinction a little bit because it'll be
Sure.
helpful for the conversation. So I mentioned just quickly in passing earlier that rich is the quest for more. And the thing about more is that it's a really good thing. So that whole survive and thrive dynamic, it's partly sort of energized by the fact that we always want more because if we didn't, we'd perish. So if you go way, way, way back over the millennia, over countless generations, what were we trying to do? Well, we're trying to find shelter. We're trying to find food. We're trying to stay safe from others, other humans and others in the animal kingdom. And so that push to survive required us to have that sense that more was better. And so here we are at the end of this evolutionary chain. For those who didn't feel that more was better, they didn't really survive. They weren't going to push to be safer and better fed and better connected and all those sorts of things. So the point is that we are hardwired to want more. And that is great because it drives success, it drives achievement, it drives survival. The problem is this, Samantha, that there are some things that we've learned from modern psychology that show us that more is ultimately quite unsatisfying in our day to day. There's something known as hedonic adaptation, which is a big fancy set of syllables that basically means that no matter what happens in life, whatever goals we achieve, no matter what mountains we climb, the quickly after we do that, we want the next thing. So one of my favorite shows of all time is Mad Men, and the protagonist or anti-hero, depending on how you define him, Don Draper. Did you watch Mad Men?
Yeah.
So he had a line that you might remember that happiness is the feeling right before you want more happiness.
Right.
That's hedonic adaptation, what psychologists sometimes call the hedonic treadmill. So we're hardwired for more. We're hardwired to want to push, but when we push and we get to that goal, we say, well, what's next?
Right.
Because that's how our DNA, that's how our genes are sort of situated. Well, that is money. And study after study shows, hey, I have $1,000,000, but I want two. I've got two, I want four. I have four, I want eight. It literally just keeps scaling and scaling. Part of the challenge for many financial advisors, I think, is that, well, they're driving larger portfolio values for their clients and they're making smart investments and they're doing all this thing. And then they get to the point where they could say to this couple, hey, you're 65 and you've saved $5 million for retirement and you could do all the things you want. And they're kind of like, okay, well, what's next? And the advisor's like, well, I thought I'd done everything right, which they had. But then there's always the next thing. So again, this isn't bad and there's nothing to really fix, but there is really a much bigger context here for the financial advisor to appreciate that no matter what good things happen for the client, there's probably going to be that pebble in the shoe that, well, I haven't done the next thing. And to take that into account as they build financial plans. And by the way, the building of the maintaining, the updating of financial plans, it's a relatively new phenomenon. I mean, financial planning's been around in one way or another for many, many decades, but the popularity of it relative to 20 years ago is quite different. So, man, this is a really long answer to a very straightforward question that you asked. So when advisors are sitting there in front of their clients trying to distinguish between rich and wealthy, they ought to understand that rich doesn't create the happiness that many of us suspect that it will. And at the same time, sort of understanding what it means to be wealthy, having a sort of subtle understanding or definition of what counts as enough. What are the true sources of contentment in my financial life? That those are harder questions to tackle that ultimately produce a lot more satisfaction in life, but it requires some preparation. It requires some study. It requires some coordination. with the client inside your firm to get to that spot where you can have those conversations.
Do you think it takes a high EQ for an advisor to be able to actually accomplish successfully what you're talking about?
So that's the best question. Absolutely. That's the crux of it. So I mentioned earlier the field of behavioral finance
Mhm.
and psychology of money, how we make better financial decisions, all that sort of stuff. That's a very popular topic in wealth management. So you go to conferences and you see speakers like me doing behavioral finance panels. What's really underneath the surface to all of that, what's even more foundational than behavioral finance is emotional intelligence.
Mhm.
So, as we push forward in the field of behavioral finance, what I call BFI 2.0, BFI 2.0 is really emotional intelligence or EQ 1.0. It's this absolute core set of building blocks that constitute a number of different disciplines. So EQ has four dimensions: self-awareness, self-regulation, empathy, and social skills. And people can think of those as almost like a CrossFit experience, where each of those four are stations with different exercises. Our IQs are fixed. No one, you, me, no one is getting smarter or dumber ever again. We just have an IQ. EQ is not fixed. EQ is a skill, so it's like cooking or your vertical leap. Like, you can be a little bit better from your baseline. You're not gonna be a Michelin-starred chef, you're not gonna be Michael Jordan, but you can be a little bit more self-aware. You can be a little bit more empathetic based on the work that you do. So a lot of what we do at Shaping Wealth is that we coach advisors in emotional intelligence, and if you don't have that orientation, then a lot of the things that I'm talking about are not going to land.
Yeah, the reason I thought about it was because I find you get a lot of, I'm sure you've studied all this as well, but you have the different types of personalities, specifically like working personalities. So there's different tests you can take. And I typically find the people who are in wealth advisory or finance, they like numbers. They're typically not all, but typically not as direct assertive. Like they're really like data driven, a little bit more conservative. But then I also tend to find because of that personality trait or that likeness, sometimes the EQ part is lower because they're not forced into as much social interaction and that kind of thing. So when you were just talking about that and it being a core fundamental of your teachings, I was wondering if that kind of like changes the curve a little bit for you and how much the impetus probably needed to be on training for EQ.
Yeah, yeah, and the more I do this, the more I lead my firm in doing this, the clearer it becomes. In fact, in some ways, the simpler it becomes that, the name of the game is emotional intelligence, that your ability to connect with others is critical, but also one of the more interesting findings or dimensions to EQ is the idea that the source of empathy is self-awareness. So I think everybody in today's world thinks, oh, okay, well, I want to be more empathetic with others. I want to understand where they're coming from. I want to be able to sort of you share their perspective, and that's great. That's a good thing. But what's not well known, and even when it is well known, is difficult to handle, is that empathy, being more empathetic, does not mean caring more. It doesn't mean trying harder to understand where somebody's coming from. The first port of call in being more empathetic is working on yourself. What are my motivations? What are my triggers? What is my story? Where am I coming from? And to the extent that we work with a lot of advisors all over the world on different dimensions of self awareness, the more that they have an aha moment where it's like, wait a minute, I've been asking questions of my clients in terms of their values and their beliefs, their dreams, their fears, their hopes, all of this stuff. But it wasn't until I came to terms with some of my own stuff that I felt like I got it, where I really listened. And like, truth be told, this is an industry that the median financial advisor is a relatively old guy. And he probably hasn't been in this track for a very for much of his life. And so as the industry changes, I think there's more openness to quote unquote going there, to saying, hey, let me come to terms with some of my own stuff so that I have sort of a context in which I can then have these emotional conversations with my clients. And there's no getting around the fact that money's the most emotionally charged topic in our lives. There's lots and lots of data to support this, more so than politics or mortality or religion. You name it, money is the number one most emotionally charged topic that any of us deal with. tying a lot to that survive and thrive evolutionary dynamic. And then we show up talking to a financial advisor, private space and intimate space, delving into the most emotionally charged topic in anyone's life. And is the advisor really capable, qualified, trained to have that conversation? In some cases, the answer is no.
Yeah, I bet. That's so interesting. One of the things that I also read, I saw the equation that happiness equals reality minus expectations. And before I have you dig in, I read this and I was like, it resonated so much with me because the one thing that I tell this to my 9-year-old daughter, and I always like reiterate this with my husband, is that if you don't like expectations will either make you the happiest human in the world, or they will make you the angriest or saddest person in the world. And I tell them this all the time because I said, I'm not a mind reader. You're not a mind reader. So, like, we need to make sure we either say our expectations or don't have any. Like, that's just where we're at. So I read this and I was like, my gosh, this is like the most, like, makes the most sense. And I loved it. So I'd love to know how you apply this to portfolio expectations and
Yeah.
to building out allocations.
Yeah, I love that you brought up this topic. In some ways, this is the simplest, most powerful insight we can have into the human condition, and it's actually quite applicable in all dimensions of our life, both professional and personal, whether it be with your partner or with your clients or within your own head, trying to do the things that you might want to do. So happiness equals reality minus expectations. Let's start with a little bit of neuroscience. I promise I won't make it technical. So one of the more interesting and powerful findings of modern neuroscience is that the brain is an engine for anticipation. That what the brain is doing a lot of the time is thinking a millisecond or a second or an hour or a day or a year ahead. And that we're constantly sort of assessing our environment. Why? Survive and thrive. I mean, I'm a broken record on this. The human body, we are wired to survive every day. Like we do fancy things like think and talk and go on vacations and and have great meals. But the body, most of the time, almost all of our systems are just here to make sure, frankly, that we don't die. So that survival instinct is everywhere. And so part of that we've discovered relatively recently, meaning in the last 10, 20 years, is that the brain is constantly creating scenarios, countless, infinite scenarios of the instant future. And then it is measuring the experienced reality relative to that expectation. And there's an emotional valence that takes place at that moment based on the delta between what you expected and what you experienced. Happiness equals reality minus expectation. So if I expected this conversation to go poorly, but we're having a nice chat, I'm a little bit happy. My reality exceeded my expectation. I'm here in Chicago. Wrigley Field is a mile behind me. Cubs are playing later today. They haven't been playing that well for a few games, but if I expect them to rally and come back and they continue to lose to the Brewers, their rivals, I'm gonna be quite upset. The equation gives us a few tools to have better conversations and ultimately better life outcomes, because we can then begin to ask, well, what do we have control over? So happiness is the outcome. That's what we want. What is reality? What is expectations? In some sense, we don't have a lot of control over reality. Like the world happens and we sort of take it as it comes. Yes, we have agency and things can happen the way we want them to. That's a really good thing. So we decide not to invest in a super risky stock because we know that it can lose 80% of its value very quickly. And so that's a decision. So reality, meaning not losing 80% of your money quickly, that's in our control. So there's lots of elements of reality that we can control, but the world's big and most of it isn't. Expectations is different because there we have a lot of control. So you're talking about your in terms of your parenting or your marriage, how explicit can we be, should we be in saying, well, these are my expectations for the way that things should go. And we can articulate that in our head, we can share that with others. And it's a really powerful moment to realize that how we feel about ourselves and the world that we live in can be to some extent controlled, manipulated is a word, but not in a negative way, that we can sort of morph those expectations to a place where they are realistic. Now, we don't want to, the game isn't, well, let's set expectations so low that we think everything's going to be awful. And then when everything's not awful, we feel good about ourselves. I mean, that's sandbagging, and that's a pretty miserable way to go through life. People, oh, it's never going to work out. It's going to be terrible. Like, who wants to be around those people anyway? Right. So we want to sort of calibrate expectations, whether it be for our portfolio or our marriage or for what's for dinner tonight, from the trivial to the profound. We want to calibrate those expectations as explicitly as possible. We want to articulate them as clearly as possible. And that really sits at the root of the happiness that we experience on a daily basis.
Absolutely. So when you're talking to an advisor about setting expectations with their clients or not setting them, the controllable variables, what are some of the advice you give them?
Well, what's going to be domain specific. So, for example, as it relates to the portfolio, there's massive amounts of evidence that over the decades, most active fund managers aren't going to beat the S&P 500. They're not going to beat the market. And so, are you setting expectations with the portfolio? The funds that you buy, the securities that you buy are going to outperform some benchmark. That's very clearly in your wheelhouse as something that you can manage expectations for. To a point I made earlier, like what it is you have control over. You have no control over the market. The market is massive. It's trillions of decision nodes that take place every day, and is what it is. It goes up, it goes down, day over day. And so the counsel we try to give is, well, what is the domain that you're working in? Could it be just with the portfolio, just with the funds or the securities that you're purchasing, the assets that you're purchasing, and how they're going to do over time? Or is it a broader conversation as to what life outcomes you're going to experience? Take retirement, for example. Like, it's the number one retirement goal that I think we kind of all think about. And most of us have this vague sense, hey, when I get into a certain age range, probably my 60s, I want to have a certain amount of money in the bank so that I can sort of transform assets into cash flow and have income to lead the life that I want, whether it be, hey, I just want to hang out with my spouse, or I want to go traveling, or I want to support the kids and the grandkids, or I want to be charitable, whatever your preferences are. Well, what are your expectations for that that experience? There's a lot of people, for example, especially men, but men and women, who think, okay, I'm going to get to age 62 or 65, and I'm going to have $5 million in the bank, and I'm going to be set. I'm good. Like, everything's leading up to that moment in time when I feel really good. And lo and behold, what we see very, very frequently is people get to that moment. There's a fair amount of depression among new retirees because they get to a point where they did the things that they thought they wanted to do. They achieved that financial goal, but they're not particularly happy. They're kind of bored. They're no longer in touch with their friends at work. They have too much time on their hands. And so when we think about expectations, like, what are it's one thing to say, hey, in a narrow sense with the portfolio, don't have the expectation that I'm going to beat the market, because that's not something a lot of people can do. It's a much richer, harder conversation to say in 5 or 10 or 27 years, when you get to that retirement date, how are you going to feel about your life? That's a large and ongoing conversations where expectations management just keeps going, and it's an iterated exchange between the advisor and the client.
When you're talking about, okay, so let's go a little bit more granular. So we're talking about portfolio allocation. And people are coming to you. You mentioned AI, for instance. They're coming to you and they see like this brand new tech coming, and because like, that is, I think that is one of the things that people have issues with when they have other advisors. They're like, no, like I saw this new company and they're the up and coming thing, and AI is big right now, and I want to allocate into that. Like, that's what I want. And then the advisors have to either give a reality check. We'll say we don't deploy into that. How do you have that conversation, or how do you guide them through maybe something that's really, really risky that somebody's bringing to the table?
Yeah, I mean, it gets back to, I think, a comment or two that I made a few minutes ago, which is having the expectation that you're going to be the person in the market who somehow has visibility into this new technology, this new company, that 10,000 investors also aren't looking at, and somehow the reality that you see hasn't been priced into the security, hasn't been priced into the market. It's kind of ludicrous on its face. Like it's not really a thing. I don't really work with a lot of advisors who are out there trying to portray themselves as someone who has the ability to find the hot new stock. It's just not a thing. Like, I've been doing this for a quarter century. It's just not a thing. Like, yes, there's VC, and yes, there's private equity. A lot of that doesn't really produce fantastic returns. So, the fact that you can have a very detailed and nuanced research report on an up and coming company, and it's like, "Oh my gosh, this thing's gonna go to the moon. This is the next NVIDIA, or this is the your next Cloudflare, or this is the next whatever." Okay, nothing wrong with trying, but our expectation should be that most of the time those things don't go to the moon. They tend to fizzle out. So again, I don't really work with many advisors who have that mindset. Those who do, I'm guessing, don't manage their client expectations particularly well. There's nothing wrong with buying a lottery ticket, and it's fun. There's nothing wrong with betting a dollar and hoping to make a million. But we know what the odds of that are. They're very, very low.
You've been in this for, you said, 25 years. So you've seen the ebbs and the flows. Like there have been some highs and there have been some lows over the last 25 years. Potentially, we actually have a lot of people who are saying that there could be a stock market crash coming in the near future. We haven't seen it, they've been saying it. But people say we've been riding so high for so long, it could be happening. So as a manager right now in today's day and age, when you're hearing a lot of the uncertainty, and obviously, like you were talking about, investor sentiment is also what makes the market shift as much as they do. How are you coaching people on how to almost balance that uncertainty that is coming? Because like you mentioned, the way I always talk about it from my husband is always like fear and greed. So it's the
Yeah.
survive, thrive scenario.
Right.
But how are you guys coaching people through that? Because there is a lot of uncertainty in our markets and what's going on.
Yeah, the thing about uncertainty is that life's uncertain 100% of the time. Like, I don't think there's more uncertainty now than there was yesterday or 10 years ago or 173 years ago. Like, we just don't know what's going to take place. The best we can do is look at long-term patterns and play the odds. Because at any moment in time, saying, "Oh, the market's due to crash," I mean, this industry is littered with bears, especially perma bears, who just constantly harp on the negative and are almost always wrong. So, yeah, I mean, personally, I've experienced the tech crash of '00 to '02, the big crisis in '08 or '07 to '09, basically. We've had multiple bear markets in the last 5, 6 years, so it hasn't been a straight up with the COVID stuff. 2022 was a crappy year. So the best that we can do in building portfolios for our clients is to play the odds based on market history and whatever current data we might think is relevant. Market timing is usually a fool's errand. And so trying to say, hey, we're going to wait for the next dip and then we're going to buy in, it's just not something that people do well. I mean, the fact that somebody has done it at some point doesn't mean that they're good at it. It means that they got it right once. So again, like I mean, the financial advisors that I deal with, and we have thousands of clients, they don't really think in these terms. They're really not thinking, okay, how do I, sort of manage this portfolio so that I can get out when things begin to get toppy and get back in when I can buy at a discount. Literally, no one can do that, and I've worked with thousands and thousands of investment managers over the years in my previous career in the fund-to-fund space. Like, nobody does that. Yes, there are some big hedge funds that do a really nice job at managing money. Almost no one has access to those offerings. They're not even relevant to 99.99% of financial advice conversations. And so, again, the best that we can do is play the odds based on market history, and if you're trying to prove your skill in being better than that, I guess good luck. I mean, I think it's our job to listen to our clients, understand what it is they want to achieve in life, and then building a financial plan, just not a portfolio, but a portfolio, insurance, estate plan, tax strategies, all of that in order to optimize or maximize the chance that they're going to be able to lead the life they want. It's actually a lower bar. It's actually easier to do that with much greater impact, positive impact on others, than it is to think in a narrow portfolio sense about, sort of doing better than others, finding the next hot thing, trying to time the market so that we think it's toppy and we're going to get out and come back in. That just in 2026, if that's your framework, you're probably a little bit too old school for me.
So speaking of old school, on my last podcast, we spoke about the 60/40 allocation and how it's really we're seeing a transition, and we're seeing how it's more of kind of what you're talking about is making sure that there's a balance in case of the uncertainty happening. So what is your take on private multifamily, private real estate, private just the private sector investments?
So, nothing wrong with private investing. I've been involved with private investing for 20 plus years. Personally, I have lots of private investments, including in real estate. Here's the deal. What are you trying to achieve? I'm a big fan. My first book, called The Investor's Paradox, dealt with this. Geometry of Wealth did not deal with this. But when it comes to alternatives, when it comes to private investing, we want to be clear on expectations. It comes back to, well, what are our expectations for return, for risk, and for correlation? Because it's going to be part of a portfolio. When we boil it down to those quote unquote simple metrics, we can have I think, a better conversation about what we're trying to do. So as it relates, I mean, I don't know, I'm not going to comment specifically on what you guys do or anything specific in the market, but one notable thing about private investments is that they are less liquid. In some cases, they're very illiquid. You can't touch your money for many, many years. Privates generally, alternatives generally tend to be less liquid. And when you take that sort of risk, and I don't mean that in a bad way, but small r, not capital R risk, when you take that risk, you should ask yourself, any investor should ask themselves, what is the premium I'm going to earn
Right.
based on the fact that I can't touch my money for a period of time? Because, like, if there's no premium, why wouldn't I be in markets with daily liquidity so that I could, come and go as I please? The question then is, well, what is the delta in the expectation of return on the private investment versus the public investment? And does that compensate me the risk that I'm taking? The risk being that I can't get my money back. Maybe I won't get it back for a really, really long period of time, maybe forever. Who knows? Now, am I being compensated enough for that risk? It becomes a very personal question, because
Right.
what's enough for you isn't necessarily enough for me, or vice versa. So I'm glad you brought up the happiness equation. Happiness equals reality minus expectations, because that expectations game is absolutely central to investing well. I mean, again, the first book, The Investor's Paradox, the thesis of that book is that expectations matter. It's that success in investing, like success in life, but success in investing is about managing and meeting expectations. And so when it comes to the promise of alternatives where there's more complexity, there's less liquidity, there's maybe more concentration in a portfolio. Maybe it's just a few assets rather than a large diversified pool of assets that's driving return. All of those different risk dimensions, we want to be asking ourselves, well, what am I getting extra for taking on that risk? And if you can't articulate it, you probably shouldn't do it.
One thing that it made me think of this and why I asked the question was because what I hear a lot from people who don't really understand private real estate or don't love it because of the time horizon, one of the things that I noticed is that a lot of times when the people who are talking to, because I talk to a ton of investors, and I like to learn about how they think, how they operate, why they do those things. And one of the things I found, and it's kind of, I'm sure it's tied to what you're talking about, is people who I've talked to who are very much I do not want that long time horizon are the people who want to be able to go in and out of the stocks on a daily, a weekly, a monthly. They really, really like the highs and the lows and doing that. And it's almost to them, it's part of what you're talking about, the want of wanting more and then having the ability to have that safety net. But when I look at real estate, to me, I like the fact, like when I incorporate it, my husband and I incorporate it because we're very much like you. We have like a lot in like the stock markets, and then we have what we have in real estate. And the reason I like this is my husband and I are different. He's more like the person who likes to have like that like instant gratification, and he's like, oh yeah, I always want more. Where I'm the person who's like, if it's just sitting there, you can't touch it. I can't touch it. It's just going to build. And then I probably can't touch it again because the taxes are so high. So I'm just going to keep, I might keep putting it there. And then that gives me this sense of security. Where the other one I feel like is like, there's like a lot more ebbs and flows. And like, I kind of let that be his plaything. So the reason I thought about it is because you're talking about the expectations, and we invest together and we have different expectations. So that's really kind of why I brought it up.
Right, right, right. Well, it's it to the extent possible, it's good to be on the same page. My wife and I do not have the same investment philosophy, I think. Think about things a little bit differently, but we're aligned in what we're trying to do. I mean, before you get to the portfolio, we want to articulate, well, what are the goals that you're trying to achieve? So if you're aligned on the goals, then the investment portfolio becomes the method, and you can tweak that, and maybe either some stuff that's more about your risk tolerance and versus his risk tolerance. The main thing for this type of conversation is, well, do we share the same values? Do we want to achieve the same things? And if so, well, then let's figure out a portfolio. And there's probably going to be different types of portfolios that get us there. But that's more in the weeds and details than it is the foundational goals and values conversation.
Yeah, I bet. I'm sure we're probably like an advisor's worst nightmare. We're like,
I doubt it.
okay, well, I want to ask you one final question, because I've taken up a lot of your time, and I'm really grateful for this opportunity to chat with you. But it is halfway through the year, like you talk about. It's cyclical. You see patterns. There's all sorts of things going on. From where you're sitting today, is there one piece of advice that you would give an advisor or to a client from if you were advising them on what to expect or what to do over the next 6 months?
Nope.
Oh my God, I love it. Okay.
Are you kidding me? I mean, absolutely not. And anyone who gives you like a 6-month market forecast, you should kick them off your podcast. It's ridiculous. I mean,
Oh my
no
God.
one knows. No, no, no.
No advice. I got it. Okay. How about one thing?
Wouldn't because it wouldn't be advice. It would be a gamble with other people's money. There's no basis on saying what's going to happen over the next 6 months. Have you seen people trying to predict like interest rates in the Fed? Like
Oh,
there's a whole industry that does nothing but that, and they're wrong all the time, and it's all they do.
it's
It's
like being
just
a weatherman.
utter waste. No, weathermen are better because I can tell you, not as a weatherman, but I can tell you here in Chicago, it's going to be colder in December than July.
Yeah.
Okay, so I can predict the future with a fair amount of accuracy. I know July is going to be much warmer than December. If you're predicting the market or interest rates or commodity prices or real estate or crypto, give me a break.
I wanted to ask you another question, but I'm obsessed with this final line from you. So I'm going to leave it at that.
Okay.
Brian, thank you. If you'll just tell people where they can find you in Shaping Wealth if they're looking for it, and also one more time what your book is.
Yeah, latest book, or the book people should read, it's not my latest book, but that's fine, is The Geometry of Wealth. And so my company is Shaping Wealth, so it's just shapingwealth.com. And we work with financial advisors all over the world. We've built an AI behavioral coach named Lydia. And so people can use Lydia for free, meetlydia.ai. And she's kind of awesome. I oversee a team of experts in behavioral science and financial planning and life coaching. And Lydia is an AI agent that's been designed to basically be one of us. And so now we've got thousands of advisors who are talking to her every day about preparing for a client meeting or thinking about sort of a financial plan or thinking about their own career or training a new advisor. So Lydia is kind of what we do. So shapingwealth.com for our big picture, meetlydia.ai for kind of where all of our energy and capital are at right now. And the book's The Geometry of Wealth.
I'm obsessed. I wish I would have asked you earlier because I love the idea about Miss Lydia, but maybe I can get you back on and we can talk about Lydia AI.
Oh, don't even, yeah, you think I'm talkative now. If you want to get me talking about Meet Lydia, yeah, you'll have to book like 3 hours.
Oh my gosh. Well, I love it. Brian, thank you so much for your time. And to all of our listeners, thank you for taking the time with me and Brian today.